Hello and welcome. My name is Sandy Hood and this is an ACCA tutorial for the Financial Management Unit, looking at a question that comes from the Kaplan exam kit. It's question 52 on page 153 of the current edition, called Ill Colleague. A colleague has been taken ill. Your managing director has asked you to provide estimates of the discount rate to be used in appraising a large new capital investment. You're given a series of estimates, some of which you can use, some of which are irrelevant. The company's gearing level by market values is 1 to 2, debt to equity. After tax earnings available to ordinary shareholders in the most recent years are given, 5.4 million, of which 2.14 million was distributed as ordinary dividends. The company has 10 million issued ordinary shares, trading at $3.21. Corporate debt may be assumed to be risk-free, bit of a clue there. The company pays tax at 35% and personal taxation may be ignored. Then we get into the questions. The first question is estimate the company's WACC using, first of all, the dividend valuation model, then to do it again using the capital asset pricing model. And you have to state any assumptions that you make. And then also, under what circumstances would these models be expected to produce similar values for the weighted average cost of capital? The next question is, the proposed investment is a major diversification into a new industry. The following information refers to the new industry, and we're given the debt to equity, and we're also given the average equity beta of 1.5. And you are asked to use any relevant information from parts A and B and recommend which cost of equity should be used for the investment. I think that's quite nice because I think they're rather giving a strong clue as to what would be the correct answer. And any relevant calculations not included in your answer to part A should form part of your answer here, and you're given 6 marks. And finally, discuss the problems estimating the appropriate data inputs for using the Kaplan model in investment appraisals. So slightly detached from the other questions. So how would I plan my answer? Well, I've got the first area A, for 9 marks, second for 6, and the third for 5. Well, I would attempt any section C question before section A and section B on the financial management paper. I think that they very often they help because you can calm down if you get anxious in the exam, and you do need to be calm when you're answering those short questions because there's no room. Either you get it right or you get it wrong. Whereas here you can get marks for your own calculations, even if they're wrong, as they roll forward within another calculation. And I would allow myself 45 minutes for each section C question. So here, part A requires calculations and assumptions and an explanation of circumstances. So it's basically got 4 little parts to it. The 2 calculations are obviously the main bit, but we need to make sure that we answer all those. I would allow 20 minutes for that. B requires a recommendation to start with and then some calculations, and I would allow 13 minutes for that. And C requires an explanation and, interestingly, is independent of A and B. It's worth 5 marks. I would allow 12 minutes for that. But I would be inclined to attempt part C first, because if I can complete it in under 12 minutes, then I've got time that I can then add to the times that I've allocated to part A and part B. And I've noticed that this discuss the problems estimating the appropriate data inputs for using the Kaplan model, which is the question in C. I could, if I was just taking it task by task by task, I could have overrun on part A when it's asking me for the assumptions that I would be making under the Kaplan approach as well. So it just helps me to to know not to duplicate. If I was to duplicate, I would only earn the marks once. So by planning for the whole question, I'm not going to get caught out like that. So now we're going to switch, and we can then start to answer the spreadsheet. So the question was, discuss the problems in estimating the appropriate data inputs for using the capital asset pricing model. Well, the capital asset pricing model has three key inputs. They are the RF, the risk-free rate, it's the equity beta, and the market average return. So nice layout. Risk-free rate, equity beta, market average return, the model tells us to use the risk-free rate we tend to recognize that investors who buy government securities such as Treasury bills do not have any risk. The problem this has is that the government can have several, probably many actually, but anyway, several securities on offer at a given point in time. These may have quite different rates, so that the choice of which security to use will influence the CAPM cost of equity. This could mean two different calculations for a company would have different values. So a fairly straightforward answer there, I think. It's just spelling out what the problem is and then what is it that makes it a problem. The equity beta is a calculated value which has typically used historic rather than forecast information, making it out of date it is used to scale up the market rate premium above the risk-free rate This means that the scaling up, well, it isn't always scaling up actually, it is used to scale the market risk premium. It means that the scaling could be out of date and ultimately undermine the value of the cost of equity produced. It has a second weakness. The equity beta tends to have been generated from the market share price movements in the past. As the market share price is live, it can change on a daily basis, making it difficult to set a precise equity beta value on a specific date. The market average return is probably the most problematic of them all. The average return in the market the words market and average are ambiguous. The market is not specified. We would generally use the FT100 again, the market share prices vary daily, and this will cause the return rate to also vary. The use of the FT100 is likely to be inappropriate for a firm operating on a lower level of the market, but even when we use the FT350 or even an AIM average, the value of the average may not be applicable to a specific company. What else do we need to say about this? Averaging market returns is also problematic. Perhaps we need to decide whether to determine the return from each company and carry out a simple average, or whether to weight it in terms of the values each are generating. I suppose there's another one which is to do with the time period, but that isn't really an input, so I would leave it at that. I think here we've probably got 5 marks, which is reasonably good for a sort of, it's a 5-mark question, so yeah, each of these little paragraphs ought to be worth 5 marks. Right, so if I move along now to my part A, and here we're dealing with the dividend valuation approach. So we got part 1, dividend valuation model. What do we need for this? Well, we need to be able to remember what the formula is. We can get it from the formula sheet, and on here you can see the dividend valuation model is shown. It's the RE value, and we've got the D0, G, PO, P0 and G. So we are looking for RE. No attempt to use the smaller casing, given that we're in the exam, and that's just really just as a guide to help me to know which column I'm putting my answers in. We know what the D0 is because we've been told that the total dividend was 2,140,000. So 2,140,000 divided by the number of shares that they have in issue, which is 10 million, gives me a $0.214 value for the dividend. The current share price is given to us in the question is 321, which we will put in terms of dollars, 3.21. We've got the growth rate for dividends, which is given as 11%. So putting this into the formula, RE equals D0, yes, that's right, times 1 plus the growth rate divided by PO, and then we add the growth rate again. So here we've got 18.4, which I'll put into a percentage with 2 decimal places, and we can now put this into the weighted average cost of capital. So within it, I need to know what the value of the equity is, and we're told that it's it's 321 times 10 million. So it's 10 million shares, $3.21 per share. So it's $3.21 million. The cost of equity we've just worked out, so that's just a straightforward equals 18.4%, and then we know the value of the debt, and that's, we were told that it's a 1 to 2 debt to equity ratio, so it's going to be half of the value of the equity, and we will present that again using the dollars. Make that column slightly wider. And then we've got the cost of debt. Interesting here, we're told corporate debt may be assumed to be risk-free. Well, we know that we would typically use the Treasury bill yield to recognise the return that the investor's getting from a risk-free investment. So the cost to us is going to be the same minus the tax shield. So we've got 12% times 1 minus 35%. So we're paying an interest rate of 7.8%. We've now got the figures that we need for the WACC. Just a little reminder of what the WACC formula looks like down here. Value of equity divided by value of debt, equity plus the value of debt times the cost of equity. Value of debt divided by the same denominator, and times the cost of debt. So putting that away, we can now find the WACC. I often find it's useful to have a VE plus VD value, just so that it just saves me having to do too many extra sums. So here I've said the value of equity is 32,100,000 plus the value of debt 16,000,000 and 50,000, give me a total of 48,015,000. So 150,000. So here we go. The value of equity divided by the total times the cost of equity plus the value of debt divided by the total times the cost of debt. And there we have our WACC for our first of our methods of working out the WACC. The next one is going to be another WACC, but this time we're going to use the Kaplan model. So for Kaplan, we're going to need to know what the risk-free rate is. Well, we've just done that, so that's quite nice. Risk-free rate was 12%. And we'll present that as a percentage. And the market rate, oh sorry, the beta is 1.4, and the market return is 16%. So we've got a Kaplan here of risk-free rate plus beta times the difference between the 16% and the 12%. Give me a value of, let me put the percentage in. I'm happy with that now, that's okay. So we'll now go on and work out the weighted average cost of capital using that. So we know what our VE is. VE is the 32,100,000. Kaplan is the KE, but I'll put it in anyway. KE is the 17.6%. And what have we got there? Value of debt, we knew that already. It's the 16 million. And the cost of debt, well, I think I can even just copy that across. So that's cost of debt, and the VE plus the VD is there, and here's my cost of debt. So putting it all together, we now have a new WACC, which is value of equity divided by total of debt and equity times the cost of equity plus value of debt divided by the combined total times the cost of debt. And there we have another figure. Now, what assumptions did we make? Well, we've got a couple of assumptions in here. The first assumption was that the dividends would continue to grow at 11%, which of course may well turn out to be rather optimistic, I suppose, but that is one of our assumptions. What else have we got? I suppose the other one is we assume the tax rate will not change, and in terms of Kaplan, And this way I avoid being repetitious. And one of the things I said before was that if I tell the examiner something twice, I'm only really going to get the mark once. But we've managed to get those in. The other question that the examiner's asked us for is the circumstances when the two would be the same. So I might have made a spelling mistake there. I think in the exam I probably would have just left it, given that the marking is not based on spelling corrections. It's about whether the marker can understand what you're trying to say. But here, theoretically, both models should generate the same value, as they both rely on estimates, and these are typically rounded to the nearest 2 decimal places this can lead to differences in this case we're just over 0.5% difference. Okay, that then concludes that particular part of the question, and then I can move on to part B, which for us is the final part. And in part B, we have to ungear a beta, and then we have to regear it and put it into the Kaplan model. The question says, you are now informed that the proposed investment is a major diversification into a new industry, and you are provided with the following information about the new industry. Using any relevant information, recommend which cost of equity should be used. So the recommendation is to use the CAPM approach to the cost of equity. So that probably doesn't got me very much in terms of marks. Then I give the reasons. That this investment is a major diversification. The dividend valuation model would be fine for investments where the business activity is very similar to the company's normal activities here. We need to recognize the effect of a different level of business risk. Kaplan allows us to do that. Okay, fine. You can see that there are marks to be earned from narrative parts of your answer, and in some respects you earn them more quickly than you do with some of the more heavy-duty calculations and so on. But we ungear the new industry equity beta to find the asset beta for the new industry. So for this, we're using our formula sheet again. We're able to take the asset beta formula here, and that's basically what we're going to use. We have already been told that the debt is risk-free, so as such the beta for debt would be 0, which means that half of the formula is not needed because anything times 0 is 0. So all we need to do is work out, using the equity beta and the industry mix of equity and debt, we can then take it from there and find the industry asset beta. So the beta, okay. We've been told the equity beta is 1.5, and we know that the value of equity is 1 to 3, so we've got a 3 value for equity and we've got a 2 value for debt, no, 1 value for debt. That gives us an asset beta of 1.23. We then put that into our equity beta, so we need to regear using the company's level of gearing. And we know that the company has 2 and 1, so the equity, the asset beta is 1.23, and the value of equity is 2. And the value of debt is 1. So we can put these in, and then we can identify the value of the equity beta for the company. So if you do this in stepping stones, then one of the stepping stones can be that you work out what the value of equity is as a proportion of the total. And here we know that we've got 2 divided by, open brackets, 2 plus 1 times 1 minus 0.35. So that gives me a ratio of about 3/4. And all I then need to do is to say, okay, well, I've got a value of 101.23 divides the asset beta divided by the ratio gives me 1.63. So taking that 1.63, which is my equity beta, I can put that into the Kaplan model. I know that the risk-free rate is 12%, and I know that the market rate is 16%. So 12% plus 1.63 times the market premium, which is 4, gives me a Kaplan value of 18.53%. And that really brings us to the end, because we did C first, and we've now completed the whole question. So thank you very much for watching this. If you want to know more about Sandy Hood Accountancy Tutor, then I don't tend to use my website anymore. I tend to use the Accountancy Tutor on Facebook, www.facebook.com/accountancy tutor, or you could send me emails. I'm primarily a classroom teacher, and so my classes are held in one of 2 hotels, one just outside Arundel in West Sussex, and the other one very close to Brighton railway station. Thank you very much, and goodbye.